My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Beans in the teens, but only just. Due to my annual leave, it has been some time since I've had a proper look at the market, so I've come to it with relatively fresh eyes and no more than my usual preconceptions. And it's a very interesting chart. Okay, the previous patterns listed in bold to the left of June are now, they're completed. And I've noticed two new possible patterns, not necessarily complementary. The first is a mid-June to date possible ascending triangle. Okay, strictly speaking, the flat topside trend line is capped by the resistance at 1459, whilst the rising mid-June to date uptrend, currently at 1329, is the lower rising trend line. That is strictly speaking. However, I would also caution you and look closely at the rising long moving average, currently 1391, as a possible dynamic contender for the rising uptrend, or at least an influence. Likewise, the flatlining medium moving average, currently 1444, could be seen as a dynamic contender for the flat topside trend line, or again as an influencer. Whatever you choose, I would look closely at the action of both of these moving averages, as they may give an early warning of what's going on. Now, a few words on ascending triangles. They can break either way. However, they tend to break upwards something like 6 to 7 times out of 10. I'm not prepared just yet to give some numbers on the size of the move, not just yet. But I wanted you to know what I saw. The second possible pattern is also related to recent events, but from early June to date. This time we take the core action that forms the ascending triangle and include it with a possible bearish halfway hesitation, with the action from early to mid-June making the left flagpole. Now, we haven't yet started really forming the right flagpole, not just yet, but this is an overtly bearish pattern as opposed to the earlier one. Indeed, you could actually extend the left flagpole out to the high of market back in May, but I personally think that would be stretching it a bit. Again, I'm not happy just yet to give any targets on the downside because it is too early. However, I wanted you also to know this potential pattern as well as the ascending triangle. These patterns are what is driving this current market. Chicago soybean meal. I wrote in my last commentary before my annual leave some 4 weeks ago, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." End of quote. During June, the market broke down through the long moving average, currently 40080, and dropped down to the lower time, currently 328.5, of the, at the time, newly drawn bearish 2021 Andrews Pitchell. Then there's target X below, which is in the 337.30 area. I think I better reprise my commentary from 5 weeks ago to better explain why there is a target X. And I quote, "The next is a little bit unsure and a little bit out there, but I'd rather say it and look a fool now than a bigger fool later, should it happen. It is to regard the whole action from the high in May to date as a possible bear flag come bearish halfway hesitation type action. I'm the first to admit it is far from perfect. But if we look at it, we do have a possible pattern here, and with a possible target X on the downside in the 337.30 area. Like I said, I'd rather look foolish now than later." End of quote. That was then, and this is now. Prices came very close to target X at the end of June, but were diverted by the declining lower time. I'll keep target X on there for a little bit longer. I just think it may still have some relevance. Since that drop, prices have, pinballed between the lower time and the middle time, currently at 374.90, with the 50% Fibonacci line of the August 2020 to January 2021 move at 376.70 and the lesser Fibonacci level at 354.30 also having varying amounts of influence. It is at this time I wish to recognise the wonderful job the bearish Andrews pitchfork has done in channeling the market lower. Brilliant. It was drawn in May and has been useful and valid up until and including this day, and perhaps for some time forward. That is the key to the market here. The bearish Andrews pitchfork, when it gets busted or adjusted to a bearish shift or some other pattern, then we can look for new ideas. But until then, that rules the incentive in this market. Chicago soybean oil. The first thing to note here is that when I last made my commentary some 4 weeks ago, I had left some unfinished business for all of you to watch out for. It was whether June would be a monthly key reversal up or down. It turned out that June was a monthly key reversal up. Please note this is a longer term pattern and one should not judge the actions of the immediately following months as necessarily negating it, if they do. The other pattern that has become obvious over May to July, bar the horn top in June, is a rather lopsided diamond pattern. I am the first to confess that it is not a pretty one, more functional than aesthetic, but it is also still there. Now a few words on this pattern. Diamond patterns can be tops, bottoms or continuations. In this particular case it will be either a top or a continuation. Today we have broken the lower uptrend of the diamond, currently 64.13, but that is not enough. Admittedly, we had a combined key reversal down and bearish engulfing pattern on Monday that triggered the move lower, but we also had 2 days of countering indecisive action before we broke lower. This is why it is worth looking at all breaks as possible false breaks to start with. Additionally, we may well have pullbacks, in this case the market going higher a bit, contrarying the move lower, then turning around and restarting a move lower. There's a couple of values I can give you in case we do have a true break in between now and next week, say. Move lower would be 10.30 cents under the value of the confirmed break of the lower diamond uptrend. In this case today it would be in the 53.80 area. A move higher would be 10.65 cents on top of a confirmed break of the upper trend line. Today that would be in the 78.20 area. I haven't assigned a target X's yet because today's move lower is not confirmed. So what's on the downside? Well, we have the 2011 high at 61 even. But the real support is the familiar old band between 57.64 and 59.44. Let's say 57.65 to 59.45. A pretty heavy duty congestion area that currently has within it the rising medium moving average, currently 59.32, and the optimized November 2020 today uptrend, currently at 59.03. A true uptrend actually would be much lower in the 56.75 area. None of this is settled as yet, but I do note that the size of the diamond top does trump the size of June's monthly key reversal up. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.